Welcome back to the Retirement Fiduciary Podcast, a place where we have authentic, no BS discussions about retirement planning, investment strategies, and wealth management. Whether you're approaching retirement or if you've already made work optional, this show is for you. Now, here's your host, Adam Koos, President, Portfolio Manager, and Senior Financial Advisor at Libertas Wealth Management Group at libertaswealth.com.
What's going on, everybody, and welcome to this first installment of NERD-vember, the podcast anyway. We're going to have at least one article, another podcast, which technically I guess we could call this a vlog cast, right? Screencast, if you will, because for those of you who are listening on Spotify or Apple Podcasts, this is going to be one of those ones where you're definitely going to go hit up a screen, go to YouTube, go to our website at libertaswealth.com, and check it out online instead, because we're going to be doing a lot of heavy charting here, kind of going through some things today. I want to focus on two of the four major components that I look at when looking at investments, when looking at what investments to buy, when to buy them, when to sell them, and so on. And those four metrics are price, trend, momentum, and volume. So today we're going to focus on the first two, which are price and trend. And so let's just jump in here. If you're looking at a chart of the S&P 500, going back in the beginning here, let's see, it's July 14th, 2023. So this goes back pretty far. But we can actually, drag this back and go as far back as we want. And if I go back to the bottom of the market here, you can kind of see the peak of the market just before the 2021-22 collapse. And I guess maybe I shouldn't call it a collapse because it wasn't really all that nasty. I mean, it was a grinding, technically a bear market. And by the way, the reason they call them bear markets and bull markets is because bears attack with their claws from the top down and bulls attack with their horns from the bottom up. So obviously bears are bad because we don't want to be attacking down, right? And bulls are obviously good because we want to be going up. So COVID isn't even on the screen here. This is the peak of the market in December of 2021 before things kind of headed down. Before that, we had small caps going down first. That's another discussion for another day. The fact that small caps and mid caps tend to go down before large caps, which means those major market indices tend to go down before we see the major market indices going down. In other words, you can start to see trouble brewing underneath the surface in the smaller companies, micro-sized companies, and mid-sized companies before you start to see, the Dow and the S&P 500 kind of start to roll over here. But anyway, we've got a period of time between, again, December-ish of 2021. Then we've got the bottom here in October of 2022, and the total decline, we'll call it an intraday, intra-week basis, was around 27.4% ballpark. So that was our decline. Then we have this kind of run up here, and I'll squeeze this down so we can see it a little bit better. But we've got this run up here off the bottom in October of 22. We had a very market peaked in July of 26. July 26, 23, bottomed in October of 23. So it was kind of a 3-month drop. Let's pull up the numbers there and see how that looked. So let's see, draw all the way to the bottom, about 10%. So 10% correction, nothing crazy. And then we had the one that we recently, where everybody was really freaking out this summer, where it happened really in about 2 to 3 weeks was all. But again, I believe it was about a 10% correction, but happened a lot faster. Yeah, not quite 10%, but close, 9.5-ish, something like that. Where they were saying the Fed should have cut interest rates more than they did, and then things ended up just being fine. And here we are, of course, post-election, with the market gapping up here. When I say gap up, what I mean is you've got this big gap up after election day. So this is November 5th. 4th is right here, this black, we'll call it, I wouldn't call it a doji, but it's a candlestick, black candlestick, kind of on a low here after a pullback. Then you get a big day here on November 5th. That's Tuesday. And then a huge day the next day on Wednesday, November 6th. And then since then, we've pretty much seen the market just kind of melting up. Now, does that mean the market's going to crash? No, not necessarily. But at the end of the day, what we have to follow is the first metric of the four I mentioned, which is price. As my friend Brian Shannon says over at alphatrends.net, Brian has coined the phrase, only price pays, and that is about the truth. There is nothing, not nothing. I would say there are very few truths more truthful than that truth, which is that only price pays. It doesn't matter if you look at breadth indicators. It doesn't matter if you look at momentum even, which is a mainstay of our portfolio management strategy. It doesn't matter if you're looking at how high volume is on up days versus down days, which is another thing that we look at. At the end of the day, if price is going up, it's supply and demand. If there's more buying enthusiasm, more buying power than there is selling enthusiasm or selling pressure, price must rise. If there is more selling pressure or selling enthusiasm than there is buying power or buying enthusiasm, then price must fall. That's pretty much it. It doesn't matter, as one person said at one of our, back when we used to do a lot of speaking engagements and events, live events and presentations before COVID, I'll never forget, there's a guy in the front row of the audience, and he says to me, I think I kind of get it, but I'm still struggling with the idea that, for instance, if Apple sells a record number of Apple Watches this next quarter, don't you think the stock goes up because they sold a record number of Apple Watches? And my response to him was, well, you're close. But if Apple sells a record number of Apple Watches and people buy the stock, then sure, the price will rise. But I'm sure if you're listening to this or watching it, you've probably encountered situations where you owned a stock in your portfolio, earnings came out, earnings were good, maybe even record breaking, but then the price falls. And the reason for that is there's a number of reasons. Fundamentalists might say, oh, well, it depends on the sales. Maybe earnings were good, maybe sales were down. Maybe the outlook for the next 2 quarters is bad or has been revised down. And you could say that those are the reasons why. But at the end of the day, the reason the stock falls, if there's good news, is because after the news came out, people sell the stock. So if there are more sellers than buyers, then price must fall. If there are more buyers than sellers, price must rise. And when I say more buyers than sellers or more sellers than buyers, again, I'm talking about buying enthusiasm, buying power versus selling pressure or selling enthusiasm. But anyway, so as you look at this chart, my sons are 14 and 11 years of age, and I could go upstairs right now, get Camden, tell him to come down here and tell me if this is an uptrend or a downtrend, and he is going to tell me this is an uptrend. So that's the second piece that I want to talk about today is trend. So today we're talking about price and trend. Trend can be defined in a number of ways. The simplest of ways is to say that just higher highs and higher lows. So if we go back here, I'm going to turn off my cursor. If we go back here, or crosshairs, sorry, we've got a high here, a higher low. This low right here is higher than the low here. This major high here is higher than this high. And even though we saw short-term lower highs and lower lows, this is a short-term pullback. It's happening too quickly for it to be considered a major high. A major high or even a major low. Because right here, this low in October of 2023 was higher than this low. And then we have a breakout again right here, heads to higher highs, little kind of consolidation right here in the middle here in January of 24. Then the market heads up. Then we have another higher high, major higher low, major higher high, major higher low again, even though people were freaking out this summer between August and I think July and August. Then we have not quite a higher high. So this is where things started to get a little bit concerning here in August, where, if we started to see lower highs and then lower lows, and it played out long enough, now you're starting to see a trend change. Because again, 1 week isn't a trend, 3 weeks isn't even a trend, 2 months might not even be a trend, depending on the market action. But when you start to see a process of lower highs and lower lows, that's where you start seeing a trend change. When you start seeing major lines of resistance, and I'll just take this trend line right here, like here's a high right here, and we can draw a line over here and say, okay, market went down, broke out above that, tried to break below it and couldn't. So what was previously a ceiling above our head is now a potential floor below our feet. The market heads up, pulls back, only spends 2 days below it, 3 days, looks like, and then manages to bounce right back up. This is what we would call a bear trap, because it went below it. It kind of indicated a potential trend change, but bounced right back above it. And then here you can see it just, we didn't even see it retest that level. If I take another trend line here and draw it across these tops like this, you can see that the market tried to get above it, couldn't, then broke out, pulled back almost back to that line in the sand, went up, pulled back almost to that line in the sand at the election, and now it's headed northward again. So anyway, this is kind of when we're just looking at price, and just very simply, lines on a chart, that's one way of looking at trend. Another way of looking at trend is using something called a moving average. Now, a moving average is the average movement of any investment over a period of time. This is the 200-day moving average that I've put on the screen here. And the 200-day moving average is simply the average movement of any investment you happen to be looking at on the screen over 200 days. And what it does is it smooths out all the choppiness so you can kind of see, it's almost like scanning out to say 30,000 feet above sea level and saying, okay, what do things really look like from up here as opposed to being down on the ground and seeing how crazy things are. So obviously the market's really choppy. I always like to see when something's below the 200-day moving average that it's below water. And that's actually why I use blue as the color I use in these examples, is because it's good. It's a good analogy. You know, if we spend a few days below water, no big deal. We can come right back up and come up for air. Here, you know, we spent a couple weeks underwater and we came up for air and we were fine. But we're sitting here in March, April of 2022, and we head back below water and we go way deep, way, way, way below water. And then when we try to come up for air, we can't do it. You know, the market can't get above it. That's a really, really bad sign. And if the lower highs and lower lows here, the major lower highs and lower lows aren't already an indication that the market is rolling over, let me back this up a little bit and show you what I mean. If I take the trend line right here and I draw it sideways here, you can see this is a ceiling of potential resistance. The market pulls back, it breaks above that, then it holds that ceiling, which is now a floor, right? A potential floor of support. But then it breaks down below it, can't get above it, breaks down, goes below water, 200-day moving average, tries to get above it and can't, back below water. And on top of that, here, let me show you this. We've also got another line at the low, which was early October of 2021. And you can see here how it went below water. We got a equal low, roughly equal low, bounces up. Now we have a lower low. And then we have an equal high, but lower than the previous high. And then it breaks down. And it's like all bets are off at that point. I mean, when I do my inverse traffic light chart, which, you know, I post every single month for the most part, at this point, we'd be in the red zone, and we do not want to be exposed in this particular investment. And what we're looking at today here is the S&P 500. Let me also qualify when I say we wouldn't want to be exposed in this particular investment. That would be in what's called a trend following portfolio or a tactical portfolio. So there's different types of strategies. But when you're looking at price and trend, and you're looking at being in or out of the market in the case of the S&P, or let's just say we're Netflix. I'll just switch it here in a second. Let me delete these real fast. And then I'll switch this over. We'll just say Netflix. So here's an example. Netflix looks totally fine right now. Uptrend, higher lows, higher highs, trading above a rising 200-day moving average. That is by definition an uptrend. Now, if you go back here, you can see if we scan back in time, Netflix was going up back in the 2020, with COVID. Didn't really have a whole lot of trouble for obvious reasons because everybody's stuck at home, right? Then it kind of hit here at this point in 2020, July, summer, kind of chopped sideways for a while. So you can see here, if I just drew a rectangle around this, you've got this, sideways movement of really nothingness. And then it breaks out, but then it starts to fall again, right along with all the rest of the stocks in the stock market as the bear market started to ensue. And then you're below water, and there isn't even an opportunity here to see, lower highs and lower lows. I mean, this thing's just, drowning. It's like somebody's pushing it below water. Look at these huge gaps down right here. Another one right here, basically on earnings, more than likely. But anyway, so that's Netflix. I'm going to pull up another one. This is Eli Lilly. Eli Lilly, which was a semaglutide, or is a semaglutide drug, one of the GLP-1 drugs, along with Novo Nordisk. They make things like the Ozempic, Wegovy, things like that. It recently fell below water, and you could argue we've got an equal high here, not quite an equal low. It's pretty close, but it's below water. And at this point, the trend for me, if you're conservative, this trend is really starting to break down. And when you start looking at other things, which we'll talk about in the next installment or the second episode for NERD-vember, as I like to call it every year, we'll talk about momentum and volume. And when you talk about momentum and we start looking at ranking investments, relative strength, things like that, that's when you start looking at something like Eli Lilly and saying, well, not only is the trend looking like it's breaking down here and it's below water, but it's also falling in terms of on a relative basis. So it's starting to see its momentum weaken as well. So that's Eli Lilly. I'm just going to, off the top of my head, I don't know, what's another? Apple. Let's go Apple real quick here. So So Apple looks fine, pretty volatile. It's been a volatile couple years here. Not as smooth as you might think Apple might be if you never look at this chart. Let's pull up. It's another good one. Peloton. That'll be fun. Okay, so Peloton did really well out of the gate after COVID, but then here we are after COVID again. April 2021, it starts to break down, gets below water, tries to get back above water, and the 200-day moving average is still rising. You can say it was flat right around here, but then it falls below water, gaps down, and we've just got lower lows, lower highs, and a drowning stock. Now, it tried to break back out here, but one of the things you got to keep in mind, whenever you see a stock break out of the 200-day moving average, I'm going to draw a trend line here, or just kind of horizontal line here. So here we go. Whenever you see something break out like that, you have to keep in mind, what direction is the 200-day moving average moving? If it's flat or rising, then you can maybe trust that breakout. But if it's falling, you really got to wait for it to prove itself, or in other words, you got to, in my opinion, give it some time to kind of see these longer-term moving averages work their way out. But in this case, it didn't. We got the ceiling here, so it tried to bounce, couldn't get above it, couldn't get above again, broke out briefly, right back below it again, and game over. This thing just kept going. I deleted the wrong thing. Give me 1 second. Okay, got it back now. We're good. Anyway, so recently, what we've seen in Peloton, you've got this breakout and kind of consolidation sideways. I can zoom in a little bit here. So we got this consolidation sideways right here. And then it's broken out again, but it's also broken out with a flat to rising 200-day moving average. So that's really interesting. Now, do I want to own Peloton right now? Not right now. There's lots of other stocks you can own, but this is an example of a way to look at trend. Now, we can speed things up if we want, but this is where things start to get a little bit weird. So let me think. What's a good example? We'll just look at Eli Lilly again. So if we look at Eli Lilly, and I get rid of the 200-day moving average, and I turn on the 50-day moving average, now all of a sudden things get a lot faster. So the 50-day moving average is the average moving over 50 days. Now the good news with the 50-day moving average is as long as the stock holds above the 50, it's really strong. When it closes below it, you can see here, if I zoom in, it closed below it here on Tuesday, the 11th of July. It wasn't able to reclaim it again on Wednesday, July 12th. Here on Thursday, July 13th, it still couldn't reclaim it. And then all of a sudden on Friday, it jumped back above it, and it was back above the 50, so back above the 50 moving average. Kind of consolidated sideways, then a huge gap up here. So I've turned my crosshairs on, and see here we were at 454, and it jumped up to 520 that just the next day because of probably an earnings report. But you can see here as I go over to the right, we closed below it for a day, another day, and then it's back above it here on Thursday. Here we closed below it on Friday, October 27th. You might think, I don't know if I want to go the weekend owning it. But on Monday, it's still below it. Tuesday, still below it. Halloween. And then on November 1st, it's still below it. Then it jumps up and we're back above it. Then below it, back above it. So you can see how if you follow, the shorter the moving average, or in other words, trend line, the shorter the trend line that you follow or that you use, the more you're going to see chances you're going to potentially get out and in over and over again. One of the rules that I like to follow, whether it's the 50-day moving average or the 200-day moving average, doesn't really make a difference, is giving it a certain number of days to prove that it's going to stay below it or above it for that matter before you sell or before you buy. So for instance, if we looked at that first spot we saw earlier here. So here it went below it for a day, back below it for a day, still below it for a day. That's 3 days in a row, and then it's above it. You can say wait 5 days, for instance. You can say 5 business days. If it closes below the 50, I'm going to give it 5 days before I sell it, and that way you might eliminate some of the whipsaws, some of the the head fakes, if you will. But there's going to be times when you look at this thing and you say, okay, it's below it here for 1, 2, 3, 4, 5, 6 days, and you're out. But then 1, 2, 3, 4, 5, 6, 7 days later, it's back above it. But then it's below it 2 days later for just 2 days, then back above it. 1, 2, 3, 4 days later, it's back below it for 2 days, then back above it. So you can get my point here. I mean, if you look at short-term moving averages or short-term trends, you might think, well, I want to get out sooner. That's always the first thing people say is, well, what if I used a shorter moving average? Then I could get out sooner. I wouldn't have to participate in as much as the drawdown when the market starts to change or the stock changes and it starts to change in trend. And that's true, but look at how many times it goes below that moving average. So you got to be careful to understand that, the faster things are, the more signals you're going to get essentially to get out, which is why sometimes in order to stay in a strong stock, the best thing to do is to use a trend line or moving average that's a little slower. So right here, there was obviously a period of time where Eli Lilly was below water for several days, but you can see very clearly here that this is a very, very strong trend. There's some time periods in here, like this is it looks like June of 2015 through July of 2018. I mean, that's a long period of time. If I draw a rectangle around it here, this right here is a time period where it's going below the 200, above it, below, above it, below, above it, over and over and over again from literally 2015 through 2018. So for 3 years, it went absolutely nowhere. And you just owned a stock and you hoped it was paying enough dividends to make you, a little bit of money. But really, from the standpoint of capital appreciation, 3 years and you got nothing out of it. It's not until all of a sudden, finally, it starts moving up here in 2018 and you start making some money, but then it pulls back for a while and so on. So this is where we'll get into more information next time when we start talking about momentum and ranking, because in a time period like this, while the trend might be flat, or we might have a flat trend or even a slightly uptrend here, when you start looking at ranking stocks or ranking bonds even, it becomes much simpler to see that, okay, even though this thing's doing all right, maybe it's better to have my money invested in something else that holds a whole lot more promise. So with that all being said, that is our lesson for the day on price and trend. I hope you found it interesting. And be sure to stay tuned and check out the next episode, which is going to be 2 weeks from now, where we'll be talking again about momentum and volume and just kind of putting the pieces together for some nerdy stuff. So if you have any questions, of course, you can always feel free to reach out to me personally at adam@libertaswealth.com. And if you'd like a second opinion on your portfolio or financial plan, retirement plan, just head over to libertaswealth.com, click on that little button that says, see if we're a good fit, answer the questions, we'll get an email, and we'll set up an introduction call to talk to you. So thanks so much. Make it a great one, and we'll talk to you later.
We hope you enjoyed today's episode. If you like a second opinion on your retirement plan or investment strategy, please head over to libertaswealth.com. This podcast is for informational purposes only and should not be considered as legal, financial, tax, or as a basis for investment decisions. Always consult a certified financial planner or a fee-only fiduciary advisor before acting on any ideas discussed.